Ever stumbled upon the phrases caveat emptor or OTC stocks and felt a tingling curiosity? Guess what? You've hit the jackpot. Today, we're unveiling the mysteries behind these captivating investment terms. We'll dive into emptor, a fancy Latin phrase which screams "let the buyer beware," and the commonly misunderstood realm of OTC, yes, over-the-counter stocks. We'll journey through the thrilling roller coaster of risks, rewards, and the uncharted territories in between. So your seatbelts as we plunge into these concepts and uncover their potential shakeups on your investment decisions. First, let's demystify the term caveat emptor, a Latin phrase. It translates literally to "let the buyer beware." This age-old principle underscores the concept that the buyer alone is responsible for checking the quality and suitability of goods before a purchase is made. Essentially, it's a fancy way of saying do your homework. In the context of investing, caveat emptor advises potential investors to thoroughly investigate and scrutinize an investment before they part ways with their hard-earned money. It's about taking the time to dig deep, beyond the glossy prospectus or the charismatic sales pitch. By embracing the principle of caveat emptor, you're committing to a comprehensive examination of the company's financial health, understanding its business model, and assessing its competitive position within the industry. This could mean poring over financial statements, researching the company's management team, or even scoping out customer reviews and news stories. But why is this important? Well, the principle of caveat emptor is a reminder that your decision to invest is just that, your decision. And with that decision comes responsibility. The responsibility to ensure that your investment is sound, that it aligns with your financial goals, and that you're comfortable with the level of risk involved. So, as a buyer, it's up to you to be aware and cautious. The principle of caveat emptor empowers you, but it also places the onus on you to protect your investment and ultimately your financial future. Now, let's shift our focus to OTC stocks. These are stocks that are traded over the counter, which means they are not listed on a formal exchange like the New York Stock Exchange or NASDAQ. Rather, they are traded directly between two parties without the supervision of an exchange. Now, why does this matter? Well, it comes down to a few key disadvantages that investors should be aware of. The first is limited regulation. Unlike stocks traded on major exchanges, OTC stocks are not subject to the same stringent regulatory requirements. This means there's often less oversight, which can increase the risk for investors. Another disadvantage is the lack of transparency. Companies listed on major exchanges are required to disclose certain financial information to the public. This includes their earnings, assets, and liabilities, which can help you make an informed investment decision. However, OTC companies are not always required to provide the same level of detail. This can make it more difficult to assess the company's financial health and potential for growth. Next, we have higher volatility. OTC stocks can be highly volatile due to their lower trading volumes and the fact that they are often less well known than their counterparts on major exchanges. They can also be more susceptible to price manipulation, which can lead to significant losses for unsuspecting investors. Lastly, there are liquidity issues. Since OTC stocks are not traded on major exchanges, there may be fewer buyers and sellers. This can make it more difficult to buy or sell shares when you want to, which could potentially result in losses. As you can see, OTC stocks come with their own set of challenges, but remember, with higher risk comes the potential for higher reward. It's all about understanding these risks and making informed decisions. So in our next section, we'll discuss how you can mitigate these risks and protect your investments. But what about the risks of relying solely on caveat emptor, you ask? Well, it's a fair question, and one that needs careful consideration. Caveat emptor, while a seemingly simple principle, can prove to be a challenging terrain for new or unsophisticated investors. Without a robust understanding of investing, these individuals might struggle to effectively assess the risks involved. It's like sending someone who can't swim into the deep end of the pool. The lack of experience can lead to poor investment decisions and significant financial losses. Then we have the darker side of the coin, scams and fraud. Some companies might exploit the principle of caveat emptor to engage in nefarious activities. They could present misleading or false information, luring unsuspecting investors into a trap. It's like a wolf in sheep's clothing, hiding its true intentions behind a facade. And let's not forget about the lack of protection for investors. With the onus of due diligence on the buyer, those who fall victim to fraudulent or unethical practices often have limited legal recourse. It's like walking on a tightrope without a safety net. The fall can be devastating and recovery a long uphill battle. So, caveat emptor might sound like a good principle, but it's not without its dangers. It's crucial to navigate this landscape with caution, armed with knowledge and a healthy dose of skepticism. Because in the world of investing, not everything that glitters is gold. So how can you mitigate these risks, you may wonder? Allow me to impart a few strategies. First and foremost, conduct thorough research before investing. Get to know the company, its financial standing, and its management team. This entails more than just browsing the company's website. It requires delving into their financial reports, assessing their track record, and studying their business model. The more informed you are about the company, the better you will understand its potential and the risks it poses. Secondly, diversification is key. Spread your investments across various assets to provide a safety net against potential losses. If one asset doesn't perform well, others might, which can offset the loss. Diversification provides a layer of protection in the unpredictable world of investing. Finally, seek professional advice. A financial advisor or investment expert can provide you with invaluable insights and guidance, particularly when it comes to OTC stocks. They can help you navigate the complexities of these markets, enabling you to make well-informed decisions. These strategies won't completely eliminate the risks, however, they can significantly reduce them. It all comes down to being proactive, staying informed, and making calculated decisions. Remember, a well-informed investor is a successful investor. To sum it all up, the principle of caveat emptor and the world of OTC stocks both present unique challenges. Buyers, particularly those new to investing, must tread carefully, conducting due diligence and thorough research. The volatility and lack of transparency of OTC stocks, coupled with the limited regulation, can make for a high-risk environment. It's essential to consult professionals, diversify your portfolio, and always keep learning. Thanks for watching. Don't forget to subscribe for more educational content on investing and finance.